Good day, everyone. Welcome back to this course, Introduction to Financial Accounting 1. Today we are discussing Chapter 4, which is mainly focused on completing the accounting cycle. The learning objectives for this chapter, as we always start with those, is to prepare a worksheet. As you may see, I put a red line across this one because we're not covering how to prepare a worksheet. The second learning outcome is to explain the process of closing the books, and then I'm going to try to describe the content and purpose of a post-closing trial balance. If you guys remember, I've told you that throughout the accounting cycle, we go through three trial balances. The first one is the unadjusted trial balance, and then after we record our adjusting entries, we create what is called the adjusted trial balance. And here we're going to look at the third one, the post-closing trial balance. The fourth learning outcome is to state the required steps in the accounting cycle, which we have already looked at previously. And then we're going to try to explain the approaches to preparing correcting entries. And finally, we're going to close this off with identifying the sections of a classified balance sheet. And we're going to learn what a classified balance sheet means. So let's get started. So let's kick this off with the closing of the books. As you may know, at the end of the accounting period, each company that needs to report their financial statements to investors need to get their accounts ready for the following period. Okay, and the way they do that is by closing temporary accounts. So we have two types of accounts. We have accounts that we call them permanent and accounts that are temporary. Now, these temporary accounts that get closed at the end of the financial period are revenue accounts, expense accounts, and owner's drawings accounts. Okay? Unlike the permanent accounts that never get closed, these include the assets accounts, liabilities accounts, and owner's capital accounts. Now, this is only carried out at the end of an annual accounting period, and the way these closing entries are carried out is by formally moving or transferring net income or net loss um, account and owner's drawing to the owner's capital account. Now remember how we said we have three different temporary accounts. We have revenues accounts, expenses accounts, and owner's drawings accounts. These are the three account types that get closed at the end of the financial period. For the revenue accounts and the expenses accounts, if you remember from our ledger accounts, we had multiple, depends of course on the company. If they have multiple sources of revenue, they will have multiple revenues accounts. And most often than not, companies have multiple expenses accounts, right? So they might have salaries and wages expenses account, utilities expenses account, insurance expenses account, and so on. So you take all of these individual revenues and expenses accounts and you transfer them to a new account that is called income summary. Now for the income summary, it will have the revenues accounts on its credit side and the expenses accounts on its debit side. And thus it's going to give you a balance which is going to match the net income or net loss of the company. Okay, you take that balance and transfer it to the owner's capital account. Okay, now the owner's capital account is a permanent account, if you guys remember. So all of the other accounts that we mentioned before, the revenues and the expenses and the drawings accounts, are temporary. Now what happens to the drawings accounts? The drawings account goes directly to the owner's capital account, right? So it doesn't go to the income summary account. Now, before we move any accounts in the ledger accounts to the income summary, remember that we have to follow a procedure. We need to record entries into the general journal first and then post them to the ledger accounts, right? Now, remember that the main goal of this is to close those temporary accounts. How do we close them? We close them by making the balance of these accounts zero, right? So in order to do that, we're gonna need to record some transactions. Now, when it comes to closing the revenue account, the first transaction that you going to record is going to close that revenue account. So you're going to debit revenue account. Now remember that revenue accounts have a credit balance. So in order to close them, we're going to take that balance and debit it to the revenue account and credit it to the income summary. Okay, the same amount that you have in the balance of the ledger of that revenue account. Now the second transaction or the second entry is going to close the expense accounts. So basically what you want to do, if you also remember from the debit and credit rules we've covered in chapter 2, is that expense accounts have a debit balance. So in order to close it, bring it down to zero, we're going to debit those expense accounts. So we're going to debit, we're going to credit those expense accounts, right? So we're going to debit income summary and credit all of these individual expense accounts. The example we have here includes supplies expense, depreciation expense, insurance expense, salaries and wages expense, rent expense, and interest expense, right? So we take these accounts total, right, and debit that same amount to the income summary and credit that amount of each account directly to that specific account in order to bring all of these expense accounts to have a zero balance. Okay, and the third entry is going to be to close net income to the capital, right? So I'm going to debit income summary with the difference between the revenue or the entry or the credit that came as a result of closing the revenue accounts and the debit side of the income summary that came as a result of closing the expenses accounts. There will be a difference between the two most of the time, right? So in that case, we're going to debit income summary with that amount and credit that to the owner's capital. All right, so that's of course in the case of that the company have generated a net income or a profit, right? And finally, after we do that, the fourth closing entry that we have to record is to close the drawings account. So we're going to close the drawings account to the capital. Remember, drawings account also had a debit balance, just like expenses. So to close it, we're going to need to credit it, right? So we're going to debit owner's capital and credit owner's drawings with the amount of the balance in the ledger account of the owner's drawings at the end of the financial period. And of course, naturally, after you record your entries in the general journal, now you're going to need to post those entries into ledger accounts. So what's going to happen is that, as you can see, we have entered, as you can say, an offsetting amount in each of the expenses account to bring their balances to zero. And in return, we're going to take all of that total and post it in the debit side of the income summary when it comes to the expenses. Whereas in the revenue accounts, we have a service revenue account here as an example. Also, we're going to offset the amount that should be on the credit side of the service revenue, which is its balance, by an amount that came from the closing entry we just made in the journal for that same balance, and move that to the credit side of the income summary, right? And from there, as I mentioned before, the difference between the two sides is going to be representative of the net income. So as you can see here in number 3 in the income summary account on the debit side, the difference is 2,860. Our revenue is higher, our total revenue is higher than our total expenses by $2,860. So that will be on the debit side of the income summary, and it's going to go to the credit side of owner's capital, thus increasing the owner's capital balance and increasing the owner's claim of the business, meaning that he have or his business have generated some profits and increased his owner's capital, right? And finally, taken out of that growth of the business or the increase in owner's capital, of course, is going to be the amounts that the owner have taken out of the business. So now here we can close the owner's drawings account directly to the debit side of the owner's capital, thus bringing down the total of the owner's capital a little bit by the same amount, of course, that the owner have taken out of the business, right? And of course, the normal progression here after we post the transactions into the ledger accounts, we post our closing entries to the ledger accounts, we can now create what is called a post-closing trial balance. Now, taking a quick look at this example that you have here on this slide, you can notice that the main difference between this and the unadjusted trial balance is that the post-closing trial balance does not include any revenues accounts or any expenses accounts. Why? Because we already have closed these temporary accounts and the owner's drawings as well. So no revenues accounts, no expenses accounts, and no owner's drawings accounts. It tells you here that the purpose of this is to prove the quality of the permanent account balances after journalizing and posting of the closing entries. Now, this takes us to the topic of the accounting cycle. If you guys remember, in previous lectures, I have shown you the 10 steps of the accounting cycle. And if you might remember that I told you that some textbooks would have it 10 steps, and some of them would argue it's only 9 steps. Some of them also contracted to 8. But the one we follow is mainly this one with the 9 steps. And the reason being, or the main difference between this one and the one that includes 10 steps, is that we do not perform a worksheet, right? So as you can see here that the accounting cycle starts with analyzing business transactions that we learned in chapter 1, and then journalize the transactions and post the ledger accounts and prepare a trial balance. These 3 steps we have learned in chapter 2, and then journalize and post adjusting entries and prepare an unadjusted trial balance, which we have learned in chapter 3. And finally, we can prepare financial statements. We learned that in chapter 1 as well. After that, we perform or journalize and post the closing entries, just like we've learned in this chapter. And from there, we can prepare a post-closing trial balance. So that's pretty much the complete accounting cycle that any accountant needs to go through on a regular basis to perform his job requirements. Now we can move on to the 5th learning outcome for today's lecture, which is to prepare correcting entries. Now, correcting entries are, of course, unnecessary if the records are error-free. So you went through the accounting cycle and everything seems fine. You couldn't identify any errors or any mistakes, then you don't really necessarily need to make correcting entries. These are only made whenever an error is discovered, and they must be posted before you post your closing entries. Okay, so instead of preparing a correcting entry, it is also possible to just reverse the incorrect entry and then prepare the correct entry in its place. Here we have an illustration to see how this correcting entry procedure is carried out. It says on May 10th, Mercato Company journalized and posted a $50 cash collection on account from a customer as a debit to cash of $50 and a credit to service revenue of $50. Now the company discovered the error on May 20th, so that's 10 days later, when the customer paid the remaining balance in full, right? So here, the correct entry that was made by the company's accountant was that he debited cash $50 and credited service revenue for $50, where the correct entry or the actual entry that he was supposed to record was to debit cash $50 and credit accounts receivable $50, right? So now we have an issue where we have an overstatement of the service revenue account, right? we have $50 more or extra in the service revenue, and we have a shortage in the accounts receivable account. So the way to do this is by um, debiting, or the correcting entry that we can carry out here is that we debit service revenue for the same amount, thus eliminating the effect of the $50 that was in the credit by mistake, and by crediting accounts receivable $50. Another example here, on May 18th, Mercato purchased on account equipment costing $450. The transaction was journalized and posted as a debit to equipment of $45 and a credit to accounts payable of $45. Now the entry here is fine, however the mistake, as you can notice, was by missing or dropping a zero. So the amount was recorded 45 only instead of 450. So the incorrect entry was equipment debit to equipment account 45 and credit to accounts payable of 45. Whereas the correct entry that the accountant was supposed to actually record was debit to equipment of $450 and a credit to accounts payable of $450. So now the amount that we have actually recorded is understated. So the value of the equipment is more than the amount that we have recorded, and the value of the liability that we owe to the supplier of that equipment is also understated. So in that case, we can simply just enter that entry again, which is debiting equipment and crediting accounts payable. But this time we're gonna the amount is gonna be the difference between the amount we initially recorded and the actual amount, right? So the difference between the 450 and the 45, which is $405, and thus that will bring up the amounts in the ledger accounts of the equipment and the accounts payable to the correct state. Let us now move on to the last learning outcome for today's lecture, which is the classified balance sheet. Now, we already learned the balance sheet in chapter 1. Now, a classified balance sheet is only a little bit different from the form or the format that we have learned before. So the balance sheet, as we've learned, that it's a report or a financial report that presents a snapshot at a specific point in time of the financial position of a company, right? And it represents mainly the components of the accounting equation. So assets, liabilities, and owner's equity. Now, what some companies do is that they group similar assets and similar liabilities together in order to improve the understanding and the transparency of their financial data that they are presenting to the investors. And the standard classification, most of the time you'll notice, is that the asset side or the asset section of the balance sheet will be broken down into 4 sections: current assets and long-term assets or long-term investments, property, plant and equipment, and intangible assets. So these are the 4 main sections. Whereas for liabilities and owner's equity, we break down the liabilities section into current liabilities and long-term liabilities. This is how the classified balance sheet would look like. This is the assets section. As you can see, we have 4 categories or 4 subsections. The current assets, which include assets such as cash, short-term investments, accounts receivable, notes receivable, inventory, supplies, prepaid insurance. Now, the common denominator here is that these are the assets that are typically used or have an expected um, lifespan of 1 year or less. Okay, whereas we have the second section or subsection, which is long-term investments, which includes any investments that the company or any stake that this company that we are reporting for owns in other investments, such as investing in other companies or in real estate and so on. And then we have property, plant, and equipment. Sometimes this is referred to as PP&E. for short, which contains what are called fixed assets. These are the assets that are expected to last for a long period of time, and these are the kind of assets that we typically might depreciate. Of course, except for land, as land does not really depreciate in value. In fact, most of the time it would appreciate in value. Um, so here we have land, equipment, and as you can see, we have the assets contra account, accumulated depreciation equipment, taken out directly from the equipment value. And finally, we have intangible assets. These are basically assets that you cannot touch, you cannot feel. So any patents, software, brands, or trademarks, and things like that, right? And that gives us the four main sections of the assets section, which is in the classified balance sheet. On the other side, for the liabilities and owner's equity section, uh, as we just mentioned earlier, that you break down the liabilities section into two main sections: the current liabilities and the long-term liabilities. Now, the current liabilities would include accounts that need to be settled within 1 year or less, such as notes payable, accounts payable, salaries and wages payable, unearned service revenue, and interest payable, right? And then the second section is long-term liabilities, and these are debts that need to be settled over multiple years or longer than 1 year. And these include long-term debts from banks, mortgages, notes payable, and so on. Okay, so these are the what are called long-term liabilities. And finally, of course, the section we know from before, which is owner's equity section. Here, let's look at these definitions, try to understand some terminology. Current assets, as I mentioned, are assets that a company expects to convert. It's either cash, or the company expects to convert to cash or consume within 1 year, or one operating cycle, whichever is longer for the company. And the operating cycle is the average time it takes from the purchase of an inventory to the collection of cash from customers. Here's an example for Southwest Airlines company. This is, of course, a partial snippet of a classified balance sheet of Southwest Airlines. As you can see, their current assets included cash and cash equivalents, short-term investments, accounts receivable, inventories, and prepaid expenses and other current assets. And these are usually listed in the order they expect to convert them into cash. So you would start with cash and then move on to the other current assets in the order that you expect to transform or convert into cash. Long-term investments are investments in stocks and bonds of other companies. These are investments in long-term assets such as land or buildings that a company is not currently using in its operating activities. And again, we have an example here for Yahoo Incorporation. They had a long-term investment in marketable securities. PP&E, or property, plant, and equipment, are long useful lives or long-term assets. They are currently used in operations. They depreciate over time. So by depreciation, we mean that we allocate the cost of these assets over a number of years. I've already explained this concept to you in previous lectures. And the accumulated depreciation, of course, is the total amount of the depreciation expensed so far from the asset's life. Okay, so little by little, you depreciate that asset each year or each month, and you add that value to the accumulated depreciation until you, which counters the value of the asset itself, until you get to the end of the useful life, where you have the assets decline in value all the way to the terminal value or the salvage value. Here's an example of property, plant, and equipment section for Cooper Tire and Rubber Company. This statement or section of the statement included land and land improvements, buildings, machinery and equipment, molds, cores, and rings. Okay, and of course, as you can see, we subtract accumulated depreciation from that, and that will give us the total PP&E, or total property, plant, and equipment. And the last classification of different assets is intangible assets, and these are assets that do not have physical substance, meaning that you cannot really physically touch them, as I mentioned before. Here we have an example from Time Warner Incorporation. Their intangible assets included goodwill, film library, customer lists, cable television franchises, sports franchises, brands, trademarks, and other intangible assets. Moving on to the liabilities and owner's equity classifications, we start that off with current liabilities, and these represent obligations that the company is required to pay within the coming year or its operating cycle, whichever is longer. These usually include notes payable, or list the notes payable first, followed by accounts payable, and other items follow in order of magnitude. Liquidity, which is the ability to pay obligations expected to be due within the next year. And of course, if you have studied finance, or maybe you'll study finance in the future, you will come across this liquidity aspect of a company and how to evaluate liquidity of a company, which is basically by directly comparing the current assets of a business, meaning the amount of cash or short-term assets that can easily be converted to cash, by the amount of financial obligations that the company need to settle within 1 year. And of course, in order to evaluate the level of health of a business organization, relates in part to their ability to have enough current assets to cover their current liabilities. Here's an example of current liabilities section of Marcus Corporation. Their current liabilities section included notes payable, accounts payable, current maturities of long-term debt, other current liabilities, taxes payable, accrued compensation payable. Then we have long-term liabilities, and these are basically obligations that the company is expected to pay after 1 year, right? And we have an example here for the Procter & Gamble company. Their long-term liabilities section include long-term debt, deferred income taxes, other non-current liabilities. And of course, deferred income taxes are tax obligations that is required from the company, but allowed by the government to be paid after a certain period of time, right? So it's usually more than 1 year. So it settles in the long-term liabilities because of that. And the last section, of course, is owner's equity, which, depending on the type of business, if you guys remember the 3 different types of businesses that we've covered, whether it was a sole proprietorship, then we're going to have only 1 capital account. And if it was a partnership, then we're going to have capital accounts for each partner. So whether there were 2 partners, 3 partners, then you're going to have corresponding number of capital accounts based on the number of owners. And if we have a corporation, then we're going to have a capital stock and retained earnings. You're going to learn more about that in accounting 2, right? Or introduction to financial accounting 2, right? And here we have an example of a stockholders equity section or owner's equity section for a listed company. This is Nordstrom. This is a company that is traded in the New York Stock Exchange in the United States. And of course, it is a corporation, right? So they're going to have capital stock and retained earnings. And as you can see in their partial balance sheet here, we can see common stock of 271,331 shares, okay, and retained earnings, of course, which are profits that are compiled from previous financial periods and kept to be reinvested in the business. And that will give us the total stockholders' equity. Here it is. That was chapter 4. I hope you guys enjoyed it. As always, feel free to ask any questions if you have any, and I'll try my best to answer each and every question. Thank you.